Hey Credit Warriors, Credit Shifu here, and we have a stock market video for you today. Before we start, just remember that this is not financial advice in any way. I am not a CPA or any kind of financial advisor. I am literally just going to share with you how I have been coping with this stock market correction, the moves I've been making, and it's just for educational and entertainment purposes only. So first of all, let's talk about it. Well, this week we have had several days of huge drops in the Dow Jones Industrial Average. Yesterday, February 27th, was actually the biggest one-day point drop in history, okay, with 1,200 points or almost 1,200 points drop on the Dow. Now, that is huge when you consider it in terms of the number of points the Dow dropped, but actually, if you consider it as a percentage, it's really not that huge at all. If you go back to the actual biggest one-day drop as a percentage, that was in 1987, where the Dow dropped 22%. Yesterday's drop, by comparison, if we have a look at it as a percentage, it was only 4.42%. But you know, it looks better in headlines. It helps you sell newspapers if you just emphasize that it's the biggest point drop in history, okay? Now, saying that though, the Dow is still down over 10% this week, so we're definitely in correction territory. Not quite a bear market yet because we're not down over 20%, but down over 10% is what they call a correction, okay? Where stocks have, been overpriced and coming off all-time highs and dropping down to more reasonable prices, all right? Now, anyone who's read Benjamin Graham's book, Intelligent Investor, Benjamin Graham was Warren Buffett's teacher, you'll know that, a big kind of philosophy of the Warren Buffett school of investing is that when there's a correction or when there's a recession or whatever, stocks are on sale, okay? And personally, I've been looking at stocks, looking at the market. I've been very pleased with my 300% gain on my Uber stock, which half of that's been wiped out now, but I'm sure it'll be back. But, I've been very pleased with the highs, but I haven't really had much opportunity to buy because everything's been at all-time highs. And so I've actually been very pleased with, at least for me, what's happened this week, the way it's kind of played out. I've been able to sell out of one stock and I've been able to buy a load of other names that I wanted to pick up, some new stocks, some stocks that I wanted to lower my cost basis on at discount prices. So it's been quite a successful week, and coming into next week as well, I'm probably going to buy more. So first, let me tell you about the two stocks that I've sold out of. First one is Apple. So I didn't hold Apple in my own portfolio. I actually held it in the account that I manage for Grandma Credit Shifu, okay, my mom. And, her stock, I think I bought it at like 165 or something. And I held it all the way up to 320 or so. And then obviously what happened on Monday, it dropped a lot. Her Apple stock was dropped down to about 300. And I thought, you know what? I think I can see that, with what's happening in China, disruption of supply chains, etc. I'm not going to mention the name of what's happening in China because apparently YouTube videos get demonetized if you even mention that. It's pretty crazy. But anyway, everyone knows what it is. So recent events in China, supply chain disruption and stuff like that could be going lower. So I sold out at $300 per share, and very happy I did that. It's now down. I think it went down to the 250s. Now it's at about 265. So, we could just buy it again and ride it back up. But I think I'm going to wait, hold off on that. But anyway, now we'll move over to my account. So there was one stock that I held in my account that actually boomed. It did really well and shot up because of what's happening in China, okay, because of this outbreak. And that stock is Zoom video conferencing. Now, this is very logical, but first of all, I give you a little bit of a background on it. It IPO'd last year. It was the only profitable IPO of the year, okay? Only profitable tech IPO. So you had like Peloton, you had Uber, Lyft, all these companies that were losing a lot of money. Then Zoom video conferencing came along. It's a business to business, like video conferencing thing, a little bit like Google Hangout, but more aimed at businesses. And they IPO'd, their company is actually making money, which is great. So their stock, it went up a bit, it went down a bit. Generally, it's been going up, but since what happened, starting late last year, early this year, with events in China, what's been happening, it just started shooting up, and certainly at the end of last week, it really shot up even more. And so I was in it. I bought into it at $77 a share, and I sold out of it on Monday at 107. And if you think about it, it's very logical it would shoot up because obviously a lot of people, let's say, flights to China are stopped. So if you've got a factory in China and you're a company in the West, you can't have a business trip there. What's the next best thing? Video conferencing with your managers in China, that kind of thing. Also, a lot of people in China are at home. They can't go to work either. So maybe their companies are also having them do video conferencing to some degree. Okay, so anyway, they've definitely seen an increase in companies, you know, creating accounts and stuff. So a lot of people are speculating as well, of course, that this stock would do well. And it has done well, okay? So anyway, I sold out of that, I took my profits, and I went and invested in a load of other names. Some of these were new stocks, like I said, and some of these were ones that I wanted to decrease my cost basis in. So I bought Boeing at 313, Lockheed Martin, LMT, at 408, Skyworks Solutions, SWKS, at 106, Micron, MU, at 53, and Uber at 31. Now, some of these were names that I wanted to get into that were just too expensive. So like with Skyworks Solutions, you know, I'm buying the dip. And some of these are stocks that I wanted to lower my cost basis on. Now, if you don't know, cost basis is the average price of share. So if you've bought, you know, sometimes you buy high, sometimes you buy low, the average cost of one share, okay? So I'll share with you Uber, for example, it IPO'd at, I think it was $45, and it went down to 25, then it went back up. I think it perhaps did hit 45, but anyway, I'll give you the prices that I've bought it at, all right? So I've bought Uber at $39, $38, $35.90, and $31.89 just yesterday. So my cost basis is $35.22. And because I've done that, I've bought every dip and lowered my cost basis. I don't need Uber to go up to its IPO price to be profitable. I only need it to go to like $36 and I'm already making money. 37, 38, 39, I'm really starting to make a lot of money, okay? So lowering your cost basis, and this is sort of another way of dollar cost averaging, but I kind of call it intelligent dollar cost averaging. So dollar cost averaging is when you just invest, say, $1,000 a month constantly, and sometimes because stocks go down, you'll get it for a lower price, and sometimes you get it for a higher price, and it averages out at a good price. This is more like you buy it when it's down, and you kind of hold off when it's at all-time highs, you know? So it's a little bit more geared towards the lower. I like to call it kind of like intentional or intelligent dollar cost averaging, or you could just call it buying the dips, I guess. We'll look at another example, and that would be Boeing. I've been in Boeing before the whole 737 MAX drama. I bought it at 405 before the first 737 MAX crash. Then it went up to, I think, around 440, and I was making money. I was like, great, this is awesome. Then that happened, obviously, which was terrible, loss of life and everything. It went down, but because I was already in it and I was at a lower level, I'd lost money on it. Instead of selling and taking profits, I had to just be like, well, you know what, I'm gonna just buy the dips now and you know, lower my cost basis, and however high this thing can get back up to, I'll probably be making money a few years down the road. So that's what I've been doing, and I've bought Boeing at you know, a variety of prices, from the most expensive at 405 and the cheapest at 313 just yesterday, and so my cost basis is now 359.92, the average price I've paid for a share. So I don't need it to go up to the price I bought it for initially anymore. I just need it in sort of the high 300, you know, mid to high 300s, and I'll be making money. I think it's actually even gone down lower now, under 300. So I may actually buy it again on Monday when I get some more money moved over into my account. So guys, that's kind of like the principle, the Warren Buffett / Benjamin Graham principle, you know, for value investors. We say buy low, sell high. You've really got to go with that. You can't be panic selling when things like this happen. I know it's counterintuitive. They call it, you know, being a contrarian in the stock market. You do have to be a contrarian, do the opposite of what a lot of other people are doing. A lot of the selling as well is to do with algorithms that are triggered, and you know, when a stock goes below a certain point, they just automatically sell. That then sends it lower, triggers other algorithms to sell. It's also to do with leverage as well, the amount of leverage involved these days, which is why you kind of get these huge drops. So a lot of it isn't as bad as it seems. And yeah, just being a contrarian, that's basically the best way, okay? The best kind of mentality. Separate your emotion from it and just look at when stocks drop, they're on sale. Like if your favorite item in a store was like 30% off or 40% off, you definitely take the chance to buy it over buying it at full price, wouldn't you? Of course you would. So anyway, if you guys are interested in stock trading and you do want to take advantage of this correction, this dip, if you want to buy the dip, I can recommend Webull, which is a partner that we work with. They are a really great stock trading app, 0 commissions, but what's different with them from Robinhood is they have a lot more intricate charts, so it has a lot more future proofing for people who, you know, Robinhood's really for beginners. Webull, I like to think of it as something for, can start start as a beginner, but intermediates and advanced, stock investors and traders can still get a lot out of it. And the promotion we have, you can actually get 2 free stocks, just 1 free stock for opening the account and another free stock for investing $100 of your own money. You're not giving that money to them, it's your money, you just leave it in your account and you can buy some stocks with it or do whatever you want with it. So, 1 free stock for opening the account and another for putting in $100. And, the value of the stock, obviously it's luck of the draw, but it can go up to some pretty high values. So you could, strike it lucky and get a stock that costs a few $100 or even up to $1,000 if you are lucky. All right, guys, so I'll put the link for that below. If you are interested, feel free to click in to download the app Webull. Please subscribe for more videos like this. And if you're more interested in this entrepreneurship, investing kind of stuff, you might want to also subscribe to my Business Shifu channel. I'll put the link on the end of this video as well. I normally do these kind of videos over on that channel rather on the Credit Shifu. But this was such big news that I figured I'd do it on the channel with most subscribers. All right, guys, have a great day and I hope you pick up some bargains in the market. See you next time. Bye-bye.